A major market crash is on the horizon, and billionaires are hastily preparing for a significant economic downturn. Today, we will hear from billionaires and fund managers on how they are preparing their portfolios for the upcoming crash. Stay tuned until the end of this video to know how individual investors like you may protect your portfolio from the forthcoming crash. Billionaires can reliably predict the arrival of economic problems long before it arrives. Additionally, the worst economic downturn in recorded history may be on its way. Preparations are underway for one of the most devastating financial disasters in human history. There are quite a few people who believe that a recession has indeed begun, but that the rest of the world is just not aware of this yet. This video will break down the tactics that billionaires are employing to protect themselves financially from the impending economic slump, and it will also show you how you may replicate their success. Timing the market is considered impossible by most experts. Indeed, timing the market is notoriously tough, but you do not need to know the precise moment in order to prepare. In order to protect themselves from impending disasters, billionaires generally utilize a variety of tactics. By diversifying their assets, they will flourish in any circumstance. People who hedge their investments will be the only ones to emerge unscathed from a financial collapse. Consider the approach taken by Elon Musk as an illustration of this. Elon thinks that the current recession, which might last anywhere between 12 and 18 months, is already underway, but he isn't trying to play the market by holding specific stocks. For him, the future isn't a foregone conclusion, but rather a potential. The economic situation is ever-changing, and you can never assume that a crash will or will not happen. Instead of risking everything on his potentially incorrect economic forecast, he hedges against the worst-case scenario.
Where do you think the economy is headed right now? Do you think we're in a recession, or is it just a risk? How do you assess our current economic situation?
Well, predicting macroeconomics is always difficult, and one should assign probabilities to these things. But ironically, I did last year. People asked me what I think about the economy. I said, well, I think we might enter a recession in approximately spring of 2022.
Called it. Nailed it. When it comes to Elon, his deeds speak louder than his words. He made the decision not long ago to let go of 10% of the salaried workers at Tesla in order to get ready for a major economic crisis. Elon is doing this to preserve their available capital. During times of inflation, it may not appear that cash is necessary, but cash flow is of the utmost importance during times of recession. This is true for both businesses and individual investors, including you. As part of its goal to shrink the supply of money over the next several years, the Federal Reserve has overstretched its balance sheet by more than $5 trillion. This move means that free money can be given out by the Federal Reserve as it did before. Even if there is a continued rise in price levels, there will be less money available if the economy experiences a downturn in the coming months. As someone who was around during the dot-com bubble, and saw firsthand how difficult it was to obtain funds during that time, Elon strongly encourages companies to gather as much cash as they can while they still have the chance.
Make sure you're not running things too close to the edge from a capital standpoint, that you've got some capital reserves to last through irrational times. Because in the past, when there's been a recession, it has gone. It's amazing. It's flipped like a light switch. I mean, David, do you remember this from the PayPal, ex-PayPal days, when we raised $100 million in March of 2000. The demand was so high, we had people like VCs, just literally without even a term sheet, wiring money into our account.
We'll send the term sheet later.
they literally would sleuth out our bank account number and wire money in. And we're like, where'd this come from? And it's like, so it was like they were literally fire hosing money in March of 2000. And then in April 2000, the market went into free fall, and it went from raising money was trivial to even good companies could not raise money in a month. So it's just important to bear in mind that PayPal almost went bankrupt in 2000. We came close. But thankfully, we'd raised that $100 million in March 2000, without which we'd be in game over, basically.
Even if Elon is one of the most innovative business people today, he's not the only one who is firing staff. Carvana fired 12% of its total workforce, Peloton reduced 20% of its personnel, and Coinbase halted new hires, revoked existing job offers, and terminated 18% of its workers. Macroeconomic worries are the common factor in all of these layoffs. The current state of the market was highlighted by Coinbase as among the key factors for the company's decision to lay off employees. A post that was authored by Altay Brock, the chief people officer of Coinbase, described how promptly reacting and responding now can help us effectively traverse this macroeconomic challenge and emerge even tougher, which will enable additional robust innovation and growth. We've discussed how cash flow is essential to the survival of organizations, but the same thing is true for individuals such as yourself. Take a business-like approach to track your incoming and outgoing funds. There are incoming revenues and outgoing expenditures. You may determine your operating cash flow by deducting your expenses from your revenue, then remove your taxes from the operating cash flow to arrive at your net cash flow. Despite the fact that your current cash flow appears to be positive, it could quickly turn negative. This is the reason why we need to place emphasis on protecting our capital. There is a large variety of ways to protect your portfolio from losses in the market, some of which have been discussed on this channel. Shorting the market is one of the strategies that has gained the most popularity in recent years. In his capacity as an activist investor, Carl Icahn oversees over $21 billion, and he has been shorting the market recently. In the business world, Carl Icahn is characterized as a corporate thief. In other words, he routinely acquires businesses and sells them for profit after he removes the business's assets. Many people despise Icahn, but he is unquestionably one of the best investors ever. Between 1968 and 2014, he generated annual returns that averaged over 26%, putting him in a league of his own when compared to Warren Buffett's profits. Icahn made an appearance on CNBC earlier this year to explain why he thinks the economy is on the verge of a recession. Icahn employs a technique that is highly speculative, which necessitates the protection of his investment holdings against the possibility of significant losses. Carl Icahn has acquired credit default swaps in commercial building and shopping center mortgages. The purchase of credit default swaps is similar to taking short selling to an extreme new level. Icahn is effectively investing in actual physical retail establishments by acquiring credit default swaps and mortgages on corporate buildings and shopping centers. This protects him from losing money on his long-term investments. It is important to keep in mind that hedging does not indicate that you are trying to time the market. Rather, it simply implies that you are safeguarding your portfolio from the worst possible result.
What's the one area of the market you're most concerned about, if there is one today?
Well, we have a very large position on shorting the malls through the CMBX through a derivative. And that whole market is a huge market. I think it's got a lot of the market itself, I think, is manipulated to some extent. And you're going to be hearing from us on that in that area. But that is an area that I think has problems, certainly in the B and C malls and in other real estate. I mean, you can't ignore the fact that, and I don't know if this is a change that will continue, but you don't have people going to offices all the time anymore, obviously. And I think that is going to militate against the real estate area, perhaps.
Icahn is short selling a sector that is obsolete and in the midst of being revolutionized by new technology. Leon Cooperman, who is also a billionaire and manages funds for investors, employs an approach that is very identical to Icahn's. From 1991 through 2018, Cooperman generated an annual return that was an average of 12.4%, which was more than 3% more than the return generated by the S&P. Cooperman, who likewise expects the economy to contract in the near future, has a net long position of 68% as of right now. This indicates that approximately 60% of his portfolio is invested in long stock positions, while the other 32% is invested in short market positions. Even while a significant number of billionaires are hedging to short positions, it's likely that a large number of you are not at ease with the idea of shorting shares. Cooperman is on record as saying that investing in stocks is traditionally a good way to protect oneself against the effects of inflation. Cooperman referred to himself as a fully invested bear prior to starting his short position in April 2022. This indicates that despite predicting a bear market, he did not engage in any short bets at all. Therefore, rather than shorting the market, he was really hedging against inflation by keeping stocks. Purchasing short-term put options on top of your existing stock ownership is another well-liked strategy of hedging. Although Cooperman holds long positions in all three businesses, Google, Amazon, and Microsoft, he has openly admitted that he possesses put options on each of them. His stock portfolio is well positioned for the long term, even if the market sells off in the near future. His put options serve as a short-term insurance policy, whereas his stock investments represent a long-term investment vehicle. Although there are some investors who could consider this to be pointless, it is crucial to place this into the perspective of beta and alpha. The correlation between the volatility of your portfolio and that of the stock market is referred to as beta. The beta for the S&P 500 index is 1. If the volatility of your portfolio is 2 times higher than that of the marketplace, then your portfolio's beta is equal to 2. A beta of 0.5 indicates that the level of volatility in your portfolio is equivalent to half the volatility of the S&P 500. The risk-adjusted return, or alpha, is calculated by subtracting the return by beta. In other words, it takes into consideration the volatility of your return. Your alpha will have a lower value as a result of the subtraction of beta if the volatility of your portfolio increases. The reverse is also true. Investing in a portfolio with lower volatility often leads to greater returns. The goal of most fund managers is to achieve a high alpha, which helps to compensate for the level of risk that is associated with their investments. Cooperman is able to raise his alpha by using hedging strategies, such as purchasing put options in addition to long stock positions. The multi-billionaire fund manager Chamath Palihapitiya is likewise getting ready for a potential catastrophe in the stock market. He thinks that individuals who prioritize alpha over beta would be the only ones to survive the impending slump.
You made a sub-economic decision, like the idea that over the last 4 or 5 years you optimized for anything except the market beta was kind of dumb. And the worst thing that you could have done in that period was confuse alpha and beta, meaning alpha is what you are able to do because of your discrete skill versus anybody else. Beta is when just the market goes up. Said differently, you could take any NBA player and put them on a high school basketball team, and they would be the college player of the year. Any single one. Okay? That's beta.
Yeah.
If you then can be the MVP of the NBA, that's alpha.
Yeah.
Okay? And I think that a lot of folks were made to feel very silly or, a downer or a wet blanket in these last few years, who will probably have the last laugh.
According to Jeffrey Gundlach, a new fund manager, the current and future economic difficulties will be addressed by his new fund, which he recently set up. Over $140 billion worth of assets is managed by Gundlach's mutual funds, all of which have outperformed their benchmarks on a consistent basis. The double-line Shiller CAPE ETF is Gundlach's most recent and innovative fund offering. The CAPE ratio is an acronym for the Cyclical Adjusted P/E ratio. This ratio, in essence, modifies the PE ratio such that it accounts for cyclical changes as well as profits. Gundlach is searching the market for the industries that are currently undervalued by utilizing the CAPE ETF. For Gundlach, the CAPE ratio was a natural choice because it takes into account the inflation-adjusted earnings of companies over the previous 10 years. Because of this, he is able to disregard swings in his short-term profitability and concentrate instead on identifying the companies that will be successful over the long term. Winners over the long term are those companies or industries that have been successful despite inconsistencies in the economy as a whole. The final strategy of risk management is portfolio diversification. In the world of hedge funds, Ray Dalio is widely regarded as the king because of his emphasis on alpha. He's insulated from virtually any macroeconomic scenario by his allocation, which includes nearly every asset. This graphic presents an overview of the holdings that Mr. Dalio's fund currently possesses. The rate of inflation may be seen along the y-axis, which goes in the opposite direction as it moves up and down accordingly. On the x-axis is the percentage increase in the US GDP. This graph demonstrates how Dalio's investment portfolio contains assets that do well in a variety of macro environments. His fund is, therefore, macro-neutral in its approach. You will be able to boost your alpha while also minimizing your volatility if you add new types of assets to your portfolio. This is due to the fact that you are accumulating assets that are not associated with one another and that have gains that are comparable, if not identical, over the long run. Dalio refers to this technique as the Holy Grail due to the fact that it is vital to attaining success in the hedge fund industry. When it comes to billionaire hedging techniques, individual investors have the freedom to choose the one that works best for them. Today, we discussed starting short positions, acquiring put options, buying stocks that are resistant to inflation, directing cash to companies that have proven their worth over time, and diversifying investment portfolios. If you want to optimize your alpha, you can utilize any combination of these tactics. Always keep in mind that timing the market is almost never a smart option. Timing the market requires going all in on short positions or keeping 100% cash. For investors, either strategy has a history of causing them to lose all of their money or miss out on a significant investment opportunity. How do you guys think the upcoming crash will play out? Which strategies do you believe are the most efficient in protecting your portfolio? Share your thoughts in the comment section below. If you enjoyed the video, please like and subscribe, and we'll see you on the next one.